called the Fiscal Fact.
Hello everyone. Thank you for joining us at Cut the Fiscal Fed. Today we are talking about protecting your money. Predatory lending, by definition, is lending that benefits the lender while ignoring or even hindering the borrower's ability to repay the debt. It is any practice that convinces a borrower to accept unfair terms that they do not need and cannot afford through deceptive or coercive actions. These unethical lending tactics trick consumers into very unfavorable loan terms. It can create a nightmare scenario for potential borrowers who lack an understanding of loans and finance. And it may take a few years before borrowers even realize they are victims of predatory lending tactics. Some consumer advocates are worried a repeat crisis of loan defaults is coming due to the pandemic and its fallout, an unpredictable economy, and unemployment numbers. This may force many Americans to turn to subprime loans. A subprime loan is offered to borrowers who don't qualify for a conventional loan due to various factors. And these loans carry more risk to lenders, which lead to higher interest rates for borrowers. Characteristics of subprime borrowers can be a FICO score below 650, debt-to-income ratio above 50%, low income, little or no credit history, having late payments, foreclosures, or bankruptcies, a spotty employment history, and potentially retirees and self-employed. Subprime mortgage lending peaked in 2005 with $625 billion in loans, leading to the economic collapse in 2008. Other types of predatory loans include auto loans, payday loans, tax refund loans, car title loans, personal loans, and even some student loans. We like to say the best defense lies in an educated offense. Here are some deceptive practices you need to be aware of. Loan packing is when unnecessary products and/or fees are added into the cost of a loan. Loan flipping is when the lender encourages a borrower to refinance an existing loan into a larger one with a higher interest rate and additional fees. Loan churning is where borrowers are forced into a relentless loan cycle in which they are constantly paying fees and interest, without noticeably reducing the principal amount owed on the loan. False disclosure is when the lender hides or misrepresents the true costs of a loan's terms, or the lender changes the loan terms after the initial offer, also known as the bait and switch. Negative amortization occurs when a monthly loan payment is too small to cover the interest accrued, which gets added to the unpaid balance. It can result in a borrower owing substantially more than the original amount borrowed. Balloon payments are when a borrower is convinced to refinance a loan with one that has lower payments up front, but excessive payments later in the loan term. If unaffordable, this could force a borrower to refinance again with another high-interest, high-fee loan, or default, or forced into foreclosure. Prepayment penalty is a fee charged to borrowers who repay a loan before its due date, and is meant to discourage borrowers from paying off a loan early because it deprives the lender of the interest they expect to receive over the life of the loan. Up to 80% of subprime mortgages have abnormally high or abusive prepayment penalties. Mandatory arbitration is when the lender adds language to a loan contract, making it illegal for a borrower to take future legal action for fraud or misrepresentation. The only option then for an abused borrower is arbitration, which is a way to resolve disputes outside of the court system and puts the borrower at a disadvantage. You also need to keep an eye out for promises. Stay clear of lenders who promise that your loan will be approved, regardless of your credit history or rating. Being rushed to sign papers. Do not let yourself be rushed through the loan process. Read the paperwork, and don't sign anything you don't agree with or don't understand. High interest rates and fees. Refuse to accept payments you know you cannot afford. Blank spaces in documents. Do not sign any documents that contain blank spaces. Unlicensed loan officers. Make sure any lender you work with is licensed in your state. Read loan documents carefully and have them checked by a trusted friend or a lawyer if possible. Federal laws exist to protect borrowers, such as the Equal Credit Opportunity Act, which makes it illegal for a lender to impose a higher interest rate or higher fees based on a person's race, color, religion, sex, age, marital status, or national origin. The Home Ownership and Equity Protection Act protects consumers from excessive fees and interest rates. And the Truth in Lending Act requires lenders to provide a disclosure form to borrowers that indicates the true costs of the loan. The best thing you can do for yourself and your money is to be an informed consumer. Familiarize yourself with the terminology, type of loan, the loan process, and the variety of products that may be available to you. Ask family and close friends, or a licensed real estate agent for lender referrals. Shop around and get multiple quotes from several lenders, including rates and terms, and fees if applicable. Do not commit to any hard credit checks until you have selected a lender. Ask a lot of questions of your potential lender. Spend some time getting to know the company and the officer you will be working with. When something doesn't make sense or causes concern, ask your questions in writing, via email, and get an answer in writing. Do enough research before paying any fees or giving out personal information. It is important to remember that as a consumer, you have the right to shop for the best loan, the right to a good faith estimate of loan charges, and the right to fair lending. Please like this video and subscribe to my channel. The more informed we are, the higher the likelihood for financial success. Join me next week, and I'll be giving you ideas on how to make money and save more money. Thank you for watching. Be safe, be smart, and go audit yourself.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 17, 18, 19, 20.